bucket strategy of investing is a way of diversifying your portfolio and giving it structure such that you can avoid as far as possible selling anything at a loss, and you can get on with living the life of your dreams in retirement. And the first short-term bucket is for maybe 3 to 5 years worth of expenditure, less any guaranteed income that you have. So things like state pension, defined benefit pension, or rental property income. And with this short-term bucket, the focus is not really on returns, it's on capital certainty. And the idea is that this money should be kind of burning a hole in your wallet, so that the idea is you go out there and spend the money and enjoy yourself and live out your retirement dreams without worrying about what's going on in the stock market. Assets that you could hold in this bucket include a short-term money market fund such as that of Royal London, which is very popular on the II community that I'm a member of. You could also have a short-term UK government bond known as a gilt, and one ticker for that is something like TN28, or a high interest bank account. The second mid-term bucket is for time periods up to 10 years. And what we're looking here is the maximum loss that you could potentially face, and then how long your assets might exist for within this drawdown, within this loss phase. How quickly do they rebound? So we're looking for things that are reasonably robust and that we've got some confidence around the underlying value of the assets. The medium-term bucket, you could hold multi-asset fund such as Orbis Global Balanced. You could maybe hold a fund that emphasizes more value and companies with low PE ratios so that the downside risk is minimized, and something like Ranmore Global Equity might be an example of that. You could possibly hold something that runs a long short strategy so that it shorts shares as well, so something like Tellworth UK Select. So that means if the market's going down, its shorts could be profitable. You could hold property or infrastructure funds within this. So there you've got the backing of real assets, and the idea is that the net asset value should remain fairly constant, fairly steady. You could hold medium-term bonds, either from the UK government or maybe global bonds, but they're GBP hedged. So you're matching the term of these bonds, say 10 years or less, with your investing horizon. And you could also look at something like a minimum volatility exchange traded fund. And here the idea is to reduce the duration and the extent of drawdowns that you might see from this holding, even though the performance is likely to be less than that of a global tracker. The third bucket is for holdings of 10 years plus. So the idea here is that no matter what kind of stock market crash comes along, you've got a strong percentage chance of having a positive return on your investments. So you just leave these untouched no matter what is going on in the world. And here is where you can go for growth, and you can look to really expand your wealth, and the majority of your wealth will probably be within this bucket. So for your long-term bucket, that's holdings of 10 years plus, you could put a global tracker in there. You could have the S&P 500. You could have a single country exchange traded fund such as India. You could also have a thematic exchange traded fund such as artificial intelligence, if you thought that the long-term growth prospects were really strong for that. You could have any company share save schemes that you have. You could have long-term bonds in here where the duration is 10 years or greater. You could have active equity funds in here. You could have like emerging markets, or you could have small cap as well. So you could have core funds that would be maybe like the global track and the S&P 500, and then also satellite funds, which is areas where you think you've got a bit more knowledge and where you think that the longer term gains could be useful for driving some growth in your portfolio. The short-term bucket, it just needs to be right sized. So if it's too large, it's going to have a drag on your portfolio. And if it's too small, there's going to be just an ordinary run-of-the-mill market crash, market correction, and you're not going to have enough money to live off for the duration of that crash. As you get older, you potentially need less money in this bucket because you've got things like the state pension kicking in, and if you've survived an initial adverse sequence of returns risk, then hopefully you need less protection later on in your portfolio because it's already held up to this market test. For the midterm bucket, the risk is that you're investing in something that probably has lower returns than a global tracker, but you've got to hold your nerve and kind of stick with it, even though the results you're seeing aren't maybe that great. And then also you've got the risk that what seems stable and what seems to have good value protection just suddenly doesn't, because each stock market crash tends to have its own different subtle nuances, whether it's to do with technology overvaluations, COVID, or some kind of banking crisis, or some kind of war. There's always something a little bit different going on. So what's been a savior in the past isn't necessarily going to work in the future. So that's possibly why you need quite a diversified range of assets in this bucket. For the long-term bucket, the risk is investing too much money in satellite funds, having too many crazy punts on things that just don't really come off, chasing performance when maybe you don't really need to. If you had a long-term wealth plan, it might show you the sorts of returns you need over a 30-year time horizon, and you just need more consistency around that. So you don't need something that's going to have very volatile performance. In terms of running the strategy, for year one, you might want to take from the short-term bucket the cash buffer if stock markets are down. If stock markets are buoyant, you might want to profit take from either the mid-term or the long-term buckets, depending on which assets you think have outperformed. So you always want to rebalance between the buckets on a yearly basis. And if you do have to take from the short-term bucket because markets aren't performing well, then ultimately you will need to top it up in line with your expenditure needs. The advantages of the bucket strategy are that it provides structure and diversification. Each asset within your portfolio has a specific role to play. It prevents selling in a panic, and it provides a psychological edge. You know you won't need to sell volatile assets too soon, and you're much less likely to run out of money as your withdrawals are deliberate and planned. You're matching your liabilities in terms of your expenditure with your assets, and you're providing a balance between short-term security and long-term wealth accumulation. You can monitor performance to check how well each bucket is performing, and then you can re-evaluate your portfolio accordingly. You're now much more comfortable holding equities because you know that you have other assets in your portfolio that you can sell if there is a market crash. The only way to run a proper bucket strategy for investing is to have a defined wealth plan such that you know how you're going to access your sources of wealth in retirement, and then you can plan accordingly in a tax efficient manner. And you also need a glide path for your wealth from something like a wealth plan or a retirement calculator, such that you can check that you're on track with your portfolio. So wealth planning, such as when you plan to retire and how much of your pension you want to take tax-free upfront, need to be integrated with the portfolio that you construct to deliver on that wealth plan. If you're interested in these activities, I'm an accountant with over 30 years experience, and you can contact me via my website.